Hello, welcome to the third episode of the Dividend Portfolio Updates. In this episode, I wanted to go over one of my stocks, which is Hershey. And first, I'm going to be looking at different metrics and fundamentals of Hershey and then reveal the price of Hershey and see if it matches up, in my opinion. So first, looking at the revenue, Hershey is a very consistent revenue grower, and you can see that there are some times where you have slight dips, like I think this was in 2015. Yep, there was slight decline, but then it starts to go up again. Slight decline in 2020, and then it starts to go up again, and here it's just about flat. So in conclusion, Hershey has very good revenue growth, like just consistently growing the revenue. It does have some small periods of slowdowns, but just in general, you can see this is just trending upwards very nicely, very consistent. It's great in terms of revenue. EPS is also very important. This is measuring the free cash flow and how much money they're actually producing per share. And as you can see, this is also really good. We just have consistent growth, and especially since about 2015, where it had a little bit of decline, it's been going up very quickly and just trending upwards, really consistent. This just looks amazing. I mean, you could nitpick and say, oh, this very recent quarter it went down a tiny bit, but it does tend to do that. It goes down a tiny bit here and there, but it's just always trending in the right direction. And this just looks very good in terms of EPS. And net income should look pretty similar. Yep, we have very similar graph. Same thing, this just shows how much money they're producing, and yeah, we have slight declines, but generally just really positive in the right direction, and you can see just the trend over time is amazing and just a sign of a really good company. Shares outstanding is also very important to take a look at for Hershey, and we can see that they are buying back shares, which is a good thing, and we can see that just consistently buying back shares over time. All these red bars are showing just quarters and years that they've bought back their shares, and this is just good, in a great direction. It looks like you can tell it's trending downwards, and yeah, that's good. And then we also probably just want to take a look at their debt. This is total assets, but if we look at total liabilities, this will show us they do have growing debt, which can be bad if you do not have the sort of cash flows and the asset value to back up that debt. So in a vacuum, this doesn't look good. You can see that the debt is increasing. It's gone up from like 3 billion, 2.8 billion to like 7.9, almost 8 billion. But if you look at their total assets, it's also growing in relation to their debt. So even though they have like 8 billion in debt, they have 12 billion in assets, and the best way of looking at this is shareholder equity. This sort of looks at the debt and the assets and kind of subtracts the debt and shows you the value left over when you take away the debt from the total assets. So you can see that even though the company is growing debt, the assets are growing a lot faster, and you can see how, especially ever since, let's see, this is 2016, you have this takeoff in terms of shareholder equity. This is probably one of my favorite things to look at is shareholder equity, because that kind of shows how the company is doing from like a standpoint of looking at the debt and the assets. So you can tell, oh, this company is actually maybe taking on a lot of debt, but they're also growing extremely quickly. And if a company is, oh, maybe they're growing kind of slowly, but they're not taking on any debt, this will also look good because you won't have any debt subtracted out. So I really like looking at the shareholder equity. I think it's a really good graph and display of how a company is doing. And you can see that Hershey, especially in these last 5 or 6 years, has just been doing amazing in terms of shareholder equity. And just generally, you can see there is some bumps here. They did have some struggles in 2015, 2016, but it is trending upwards, and that's what we like to see. And just the growth here is insane, like 18, 27, 28% growth. It's crazy to look at. And you can also look at cash on hand. This is less important in terms, like, them having cash on hand is good, but if they have good places to spend the cash, I'm not really concerned with them using it. I think it's good to have some cash on hand, especially when you have debt, but I don't think it's like the end all be all. You don't need a ton of cash on hand, but it is nice to see a little bit. And they haven't really been, it looks pretty flat in terms of cash on hand. They do have spikes where they'll go up, but then they'll go down, and it doesn't look like it's really growing or going down too much. So that's fine. This is just interesting to look at, but I don't think it matters a ton, especially if the company has good places to use their cash. This is long-term debt. I also just like to look at this just to see how much of the debt is long-term versus short-term. It looks like about half of it is long-term. And it looks like it definitely grew a bunch from 2015, 2016 to 2020, and since 2020 they have been pretty stable in terms of long-term debt. Now if we take a look at the other ratios, we're going to look at quickly, I want to take a look at the price to earnings ratio. This kind of can help you determine if a company is overvalued or fairly valued, what the valuation is, because it kind of keeps track of the earnings versus the price of the shares. So we can see that Hershey has trended upwards in terms of PE ratio. Like they've gotten pretty high. Like in 2009 they were down at like 13, but as the company has grown and as they've sort of matured as a company and gotten to the point where they're just a really consistent like revenue grower and a great company, people have started paying more of a premium for the company. And you can see that it got up to about 30, but I'd say on average it looks like we average out around somewhere around probably 23ish, around here, 23, 24 PE ratio. And it's come down a lot recently, and currently we are sitting a bit below the average probably of the last 10 years at about 20.74 PE ratio. Now I wanted to kind of do this because now we're going to take a look at the actual price of Hershey stock. And just based on all these things we've looked at, it looks like a very strong company, and everything is kind of telling us that this company is doing well, and it's a very consistent, great, established sort of company that has done well in the past. And a lot of things are looking very good for the company in terms of earning growth, in terms of shareholder equity, and in terms of like just the EPS growth and all that. So now we're taking a look at the price of Hershey and how that compares. So this is the share price, and let's just go like the last 10 years. So that's what we were looking at in terms of the other metrics. So let's look at 10 years. As you can see, Hershey has been doing super well, especially after around 2018. You can see there's a very fast growth from $80 a share to like $270 a share. So it experienced a lot of growth. Before that, this is when it was going through its struggles in like 2015, 2016, and it was kind of flat. But you can see, especially recently, it's just dropped down to Right now I think it's at $188 a share, but it's dropped about 30%, so it's kind of come down from those highs. But just looking at a lot of the fundamentals of Hershey, you can see that this is a really good company, and everything is kind of growing and going in the right direction. So why do we see this huge drop? And part of the reason, I think, is because of valuation. Hershey got up to that 30 PE ratio that we saw, so a lot of people probably thought maybe Hershey is overvalued. I don't think anyone is thinking that Hershey's like a terrible company, just that, oh, maybe it's not worth it for 30 PE. Like, yes, Hershey's going to grow, but it's not going to grow as fast as some of the like tech companies. And 30 PE is like a typical thing you'd see of like a tech company like Microsoft, but not necessarily like a more slower growing company like Hershey. So that is probably one of the major reasons. There was also sort of issues with people taking weight loss drugs like Ozempic, and there was this whole craze where people thought that stocks like Hershey and junk food stocks would take a huge hit because people wouldn't buy them as much anymore when they started taking Ozempic. And I'd see that as kind of a short term and kind of, I don't know, it doesn't seem like a real issue to me. It just seems like a kind of scare that the market went through, but not really like a long-lasting detriment to the stock. And then there was also, I think there were like increased cocoa prices for a little bit recently, so I think that also might have had a slight impact on the stock. But none of the things that I've seen with Hershey are really long-term issues. I think the main thing and the main reason why there might have been a sell-off is mainly due to the valuation being high. But I think it's still a super great company, and I'd be willing to pay a little bit of a premium for a great company. And now, as we saw, the PE ratio has come down to about a 20 PE, so it's actually below the average in terms of the last 10 years. And over the last 10 years, I'd say Hershey has done very well and shown that it is a great company. So if anything, I think the sell-off is a little unwarranted, and I don't know if it's completely indicative of how Hershey is doing as a company. That being said, it did race up a lot, so this might just be a little bit of a correction, and we can see if we drew like a line from here to here, this is still trending upwards heavily. But I think at 20 PE, Hershey is a very solid company, and it will continue to grow in the future, and it's just going to be around for a very long time. And I think now is a really good entry point, and that's why I have started buying Hershey. I think I started buying it when it got down to like maybe like 220. I started buying, and I've been buying it ever since. So I've kind of sort of ridden it downwards in terms of share price, and I don't typically like recovery plays because the main reason I kind of dislike a recovery play is I don't think good stocks should need to go through recovery plays. I think a good stock should just mainly be headed in the right direction, and they shouldn't run into like those sort of windfalls. Like, they should be able to anticipate sort of issues that come their way and sort of avoid them before they happen, and just be as perfect as possible. So companies like Apple and Microsoft that almost never go down, I just like those sorts of companies. And I rarely will try to buy into a company just because it's fallen a lot and because it's going through issues right now. But Hershey is one of the few cases where I feel like this is a excellent company, and this sort of sell-off and drop in share price isn't reflective of the company, and like it's just a rare occurrence. Like, I feel like a lot of people buy into big dips in companies and try to play like recovery plays, but I feel like a lot of times you can be buying into like a value trap when you do that. And that's why I try to avoid them for the most part. But every once in a while, when a very great, excellent company goes through one of these dips, I will sort of play for that recovery play. And even though it's not really my investing style, and Hershey's one of the few companies where I see it as, even though it's going through these sorts of hard times, I'm not sure if you'd call it a recovery play since it's only down like 30-ish%, but I'm willing to go into it because I think that it will recover and do very well in the future. I think the main point is just that this isn't something I typically look for in terms of plays. I don't usually look for recovery plays. So the fact that I am looking at Hershey and thinking of it as a option just shows how good of a company it is and how much confidence I have in Hershey. The fact that it will, I think, recover. And yeah, that's my sort of take on Hershey. And now let's take a look at the portfolio. All right, here we are at the portfolio. Today I wanted to take a look at dividends because this is a dividend portfolio, and I wanted to see sort of how we're doing in terms of annual income, and so that we can track that in the future. And we're getting close to a big milestone. We have $493 in annual dividend income right now, and hopefully we can reach 500 soon. As you can see, the portfolio is up to 26,600, so that's about a $2,500 increase from the last episode. And here are the stocks and how they contribute to the different percents of the portfolio, as well as the estimated dividend income. SCHD is definitely leading the way. It's a big percentage, 22% of the account, and it has about $200. These are the two non-dividend paying stocks. They're both pharmaceuticals companies, and they're sort of both in my biotech play. Both great companies, but they don't pay a dividend, unfortunately. We have Hershey is the second biggest dividend payer at 59, and then Target is at 52. BlackRock is $50 a year. Rockwell Automation at 25. Nike at 21. We have Carrier Global at 26. Intercontinental Exchange at 11. NVO at 22. And Lam Research at 13.75. And Costco is only at 8 because it has such a low percent yield. So that's sort of where my dividends are coming from and how the portfolio is growing. And we talked about a lot Hershey in this video. It is underperforming a lot of the stocks in my portfolio, but I am still very confident about it, and that is why it's such a big percentage. It's like my third biggest holding in terms of percent of the account, and I'm just happy I'm getting dividends and getting them to reinvest while the stock price is so low. But yeah, thank you for watching, and I'll see you guys in the next one.